Let's turn our attention to looking at what is a balance sheet. Now, as the name suggests, the balance sheet is something that is a combination of two parts of the business which would balance each other out. It looks at what you owe versus what you own. What you owe is going to be termed as the liability, and what you own is going to be termed as the asset, right? It's also a sort of a snapshot of a business at a point of time, right? So the next moment it could change on how the business works. It's important from the perspective of the health of the business. It shows an equality, which is what is your sources of funds and what are your uses of these funds or application of these funds, right? Let's understand that. So when a business starts, you have something called as sources of funds. You will raise money from someone. What are these sources of funds? You could either raise share capital from the owners of the company. It's also known as equity. Or you could raise what is called as debt from lenders, and you could start the business using this. There are other sources of funds as well. So for example, if a supplier gives you raw material but you have not paid for that, that's also a liability for you, right? You're using this on someone else's money basically, right? So these are the sources of funds which you will use, and then you will apply these funds, or you will have application of these funds in terms of either long-term assets, right? And long-term assets could be divided into, as we know, tangible assets, which you can see, feel, look around you, which are physical assets like, let's say, building, land, plant, machinery, etc., or intangible assets, which could be, let's say, software, which could be license, which could be goodwill. These kind of items come into this, right? And it could also look at some sort of investments. It could look at any kind of short-term assets. So that's basically the snapshot of the business, where you're basically raising money through these sources of funds, which will then of course become your liabilities. Remember, this money is supposed to be paid back to the owner of the company or the debt provider for the company, and application of the funds basically become your assets, which are business generating assets. At any given point of time, these two have to balance. So suppose you raise 10,000 rupees as equity and take 10,000 rupees as debt. That's going to be your liability as 20,000. On the other side, you will probably have this money available as cash. That's 20,000. Then let's say out of this 20,000, you're going to buy 10,000 rupees worth of assets, and the other 10,000 will remain as cash. So at any given point of time, if you have raised money, you would have either used it or it will be available as cash. There's no other use. So practically, the total amount raised versus used plus available has to be equal at all points of time. Every transaction that the company does after this is either going to rearrange items on one side of the balance sheet, for example, cash going to long-term or fixed assets, or if you raise another 10,000 of debt, for example, so this becomes 20 plus 10,000, that's going to become 30,000. On this side, that's going to add another 10,000 of cash. So that's also going to make this 30,000. So it's going to change items on both sides. So either every transaction or decision that the business makes is going to impact both sides of the balance sheet, or it's going to rearrange items on one side of the balance sheet. At any point of time, the balance sheet cannot remain unbalanced. It has to remain balanced at all points of time, right? So that's what we have. Sources of funds are basically liabilities, since we have to return this to the lenders and equity holders. Application of funds is assets, since these are the resources which will generate revenue for the business, right? That's the broader context. Now, while we are at it, let's try and understand how does the business model work. Let's assume a company issues share capital of 1 lakh rupees. How do they do that? Let's say they have 10,000 shares of 10 rupees each. So as the business starts, at the onset of the business, this money is lying as cash on the other side. The balance sheet balances. Perfect. Now in the next stage, let's say the company chooses to buy fixed assets, any kind of fixed assets. When they buy fixed assets, the cash gets transferred to fixed asset account. right? Whatever the accounting entries around it is not our headache at this point of time. We're just trying to see how the balance sheet stays balanced. Total assets, 1 lakh. Total liabilities, 1 lakh. Now let's say the company does business and the business generates a final cash profit of 20,000, right? So what will happen? Cash profit will increase the cash by 20,000. Now that creates a problem because the balance sheet size is 1,20,000. Now whose money is this cash? This cash or this profit belongs to the shareholders of the company. So either it could be distributed, in the form of something called as dividends, or it could be retained. It could be retained so that it basically gets reinvested into the business. If it is getting reinvested into the business, remember, whose money is this? The shareholders. So it appears as another line item on the other side, where this entire thing together now, share capital plus retained earnings, also known as reserves and surplus. That's the same thing, just that reserves is a more all-encompassing term. It has other kinds of reserves as well. But for simplistic understanding, this was the shareholder money. If they did not take it out as dividend, they said, let's put it back into the business. This 20,000 is available for the firm. And if I was the shareholder, this is my claim in the firm. So total liabilities now become 120, which is the same as total assets, which is 120. Two interesting portions. This entire data point, both of these put together, are known as the net worth of the company or book value of the equity of the company, right? The other thing that is there is that the number of shares is 10,000. The total value is now 1,20,000. So the share price must have gone to 12, right? That's how the share price basically moves. If you make a profit, it increases your claim in the business. The share price is supposed to reflect that. Now, in real life, of course, the share price depends on a lot of other things as well. So this 12 is obviously profit that the company has already made. There could be expectations about what is going to be the profit next year, right? So if in the subsequent year, the company makes a profit of 60,000, then obviously the total balance sheet size would become 1,80,000. Retained earnings will add that 60,000 to become 1,80,000, and the price will become 18 next year. Now, someone could choose to buy the stock today, not at 12, but at 15, because the expectation is that it is going to go to 18. Right? Now, what happens in real life is something else altogether. But remember that the stock price should be 12, but it could be less or more depending on what is the expectation from this business in near future. Remember one thing, however, that the balance sheet, look at this term, it keeps adding to the previous term. So the balance sheet per se is a cumulative or additive data point or statement, which basically means it keeps adding to previous year numbers. That's an interesting point. Note that the profit and loss statement is a periodic statement, so it does not give information about previous periods, but the balance sheet, just because it is additive and 80,000 appears here, is going to give information about previous periods as well. It is going to have an information about all the assets that you have bought in the past. So because of this nature, the balance sheet becomes a more interesting and important statement. It gives you more information than what is directly visible on the surface of it if you dig deeper into it. That's broadly what is there in terms of a balance sheet. That's it in this particular video.